Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding, sitting next to Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. If this is the first time you are tuning in, be sure to hit that subscribe button, both on the podcast and the YouTube side of things. Leave us 5 stars. I mean, come on. We've been doing this for 3 years. We're over 300 episodes. If you're still listening, I hope you've benefited. 5 stars, small price to pay, probably about 10 seconds of your time. 5 stars, rating and review. We love all the support. Go to focuscompound.com. Jeff writes about ideas there. You can get access by signing up for $50 a month or $60 a month. Hit that subscribe button there and you can sign up and get access to that. And check out all of our content. Follow me on Twitter at focuscompound. On Twitter, that's probably the best place to get everything that we do. So thank you so much for all the support and being along with us. I'm wearing a what's this thing called? Like a sweater? What do they call this? It's like a long sleeve shirt. It says welcome, welcome, welcome. Maybe, I don't even know. Hopefully you could see that. Shout out to my friend Clark. You're the best. Welcome, welcome, welcome. That's kind of funny. I don't even know why I started doing that, and now I have to do it every single time. Because people on Twitter, they go with the cadence. They go through the whole intro sometimes, and it's the funniest thing. I love seeing it. So shout out to Clark. Somebody asked me, they're like, "Are you gonna make merch like that and sell it?" I'm like, we're not doing this we're just trying to manage capital here and like put content out into the world.
We've talked about doing merchandise for purposes other than making money on it. Like we could do something to give it away or something like that. We talked about that.
Yeah. So I don't know. We'll explore that. So in today's podcast, we're going to be talking about something that I think is going to help out a lot of people, and that is the psychology of investing.
Okay.
So everybody was super bummed when a couple podcasts ago you said that you think 9 out of 10 investors are actually hardwired to be investors, or 9 out of 10 people are hardwired to be investors. And I want to talk about the psychology of investing, everything that goes
9
into
out of
it.
10
are not.
Correct.
Correct.
Yeah,
Did I say
9
they
out of
are?
10 people.
Yeah, sorry.
Yeah,
are not.
I think that's
the
right.
major bummer part. Are not.
To pick stocks. Yeah. I'd say most people are not to be in the market, but definitely 9 out of 10 are not, that they should, not be picking individual stocks. Yeah.
So Joel Greenblatt in his Columbia class, special situations class, I watched it and I've also read the audited notes. Google it. You can get access to it. It's awesome. He said, the intro was, Warren Buffett says that you should index and I think you should too, but he doesn't and I don't either. So let's talk about investing, right? And I thought that was a very interesting opener, and it's very true. Because I feel like most investors do think other people should index. But if you're listening to this podcast and you're like us, you probably don't yourself. So there's some psychological things that we could work on to improve the process. Mm-hmm. So tell me, why do you think 9 out of 10 people are not hardwired to be investors? And again, we're talking about investing. We're not talking about speculating or gambling.
Right.
I mean, let's break down the definition, right? We could bring it back to the Benjamin Graham definition. I mean, what's the difference between investing and speculating?
Well, I mean, for me, I think the difference is that in an investment, you're trying to get your return from the underlying asset. And in a speculation, you're trying to get it from the marketability of it.
So the actual price of, or the actual returns that the business generates versus the price in the market is what you're saying.
Yes, I think so. I think marketability is the key to speculation. Yeah. But different people will disagree on that because the word speculation obviously does mean different things. So, is merger arbitrage and stuff speculation? It's speculating on the future that way. And so you could also argue, isn't buying Tesla the same kind of speculation as merger arbitrage? Isn't it just a matter of the probabilities and stuff like that? But it is interesting that a lot of the investors we talk about, value investors, Graham, Greenblatt, Buffett, all those people did dabble in things like arbitrage and stuff and didn't usually in buying really expensive stocks. So
why do you think that is? Keeps them bored or keep them busy? Keeps them from
I think there's similarities. I think there's similarities to it. I think the kind of speculation that we're talking about is more like is focused on the marketability of it, of the stock going up, and not on the underlying asset, if you want to call it that. I mean, in the case of arbitrage and things like that, it has to do with whether an event will or won't occur, the probabilities involved in that. but it has to do with something objectively apart from the market. I think that's the big difference. When I talk to people, that seems to be the big difference. Outside of my professional life, whenever I've talked to someone about stocks, the difference is that they're talking about the stock as what it's doing in the market, right? So they're talking about price things. They're talking about what they think about people buying and selling, whatever those things are, the news things that they're seeing, whatever that is, which is very different from talking about the business or the underlying asset or whatever.
Do you find it hard to talk to people about stocks that aren't in the industry, or sort of where you could, go back and forth with? I find it very challenging. And I know they say you don't understand something unless you could explain it to a 5-year-old. Okay. But I feel like I can't offer much insight because everything I would tell them, they just wouldn't be interested in anyways.
That's probably true. But I'll just tell them even if they're not interested.
I'm just always like, go buy an index fund, or that's cool. I don't know. I find it challenging sometimes. And a lot of times too, it's because everything that we do is just not sexy right now. So if I do start to talk about it, I see their eyes kind of like veer off to the side, and I'm like, they're not interested at all.
Yeah, that's probably true. Yeah. I mean, I usually encourage them to, if I know that they work for a public company or something, or trying to get them to say that they work for a public company, then we can figure that out. What industry that's in, if their own company is in public, what industry do they work in, the area. At least I know some companies in the area and in the right, county, state, things like that. I could probably come up with some names of publicly traded things, and then things they're interested in, right? So at least you could find stuff like that.
Look at you connecting with them.
So,
no, it's interesting. So you've watched this. I think this is interesting. The very first part of like talking about like the psychology of investing is knowing yourself.
Okay.
Right. Do you have what it takes to be a concentrated investor? How will you react in certain situations? I forget the exact test name, but Monish talked about, I think early on in his career, you know what I'm talking about? He did like some sort of test where you talk to people for...
He did very involved psychological testing where it's sort of like a 360 review type thing.
To really get to know yourself. And then they give you this report on Geoff Gannon, or this report on Andrew Kuhn. And he actually said that one of his friends did it. And his friend was like, I hated reading about the person that I read about.
Right.
So I thought that was kind of interesting, really, just to know yourself. I'd like to take a test like that, I think.
Maybe.
Yeah, maybe, right? But do you think that's like a pretty good, I mean, like you, for example, like you know yourself, you know how you react in certain situations. Price moves for you are purely irrelevant. You focus, purely on the look-through earnings and the actual business itself and stuff like that. So do you think that's a pretty good starting point for people to, I guess, go down this path of the psychology of investing?
Yeah, I think go back and look at what actual mistakes you think you'd made and what things you did right, and you'll find that it can be quite different from what you expect and what you spend time on. I spend time way too much on certain things that, based on my past record, isn't really that useful. I'm too biased to doing things, even though I'm much less so than other people. But if you look at my record of decisions that I made in the past and things that I do now, and how I organize stuff in terms of my day and what I do and all that, it's way too biased to trying to do too many things in small ways and stuff, as opposed to doing a few big things very rarely.
Okay, so tell us about that. What do you mean?
Well, for instance, way too much paying attention to the price of the stock, right? So is it cheap enough? Is it a value stock? As long as it's just cheaper than, or as cheap or cheaper than the average business, then if you look at my past record on things, I just buy it and hold it. It's fine. It's not hard usually to determine if a stock is a bit cheap. And I don't really need to know if it's super cheap or a bit cheap. And then just not selling it when it goes up a little bit, unless it goes up to an extremely wrong price. So worrying too much about whether buying something when it's 7 times earnings instead of 11, and then wondering about selling it when it's at 25 times earnings instead of it being at 50 or something. So if you just look, that my past record is definitely an issue, thinking too much about price that way. But I want to warn people about that, because for most people that's not true. One of the big problems is, there's sort of 3 things, I guess, that I'd say people, that happens with people of what they do wrong. Buy the wrong business, right? So they buy bad businesses, they pay too much for the bad businesses, and they trade them too frequently. And that's usually what's going to happen to most people, and that explains most of your errors. each of us have our own sort of biases, and my bias is pretty strongly towards not paying too much. So what I'm saying is a mistake that I make is unlikely to be something I need to remind other people. Most people do not need to be encouraged to be willing to pay enough for a business they really love. But in my case, worrying too much about the very cheapest things or whatever would be a problem.
Yeah, and you've talked about on the podcast how other times how that's how you are, and it's just if you see $100 bill on the ground, no matter what it is, it's like you have to learn about it, and
Correct.
If you think it's worth $200, for example, like you just have to learn about it. That's the bias that you have.
And yet that's a little different from Parai, because I won't buy things that have a really big upside, but some downside to the point that it could be 100% loss, even though the probability is low, that look really cheap. So even though he would probably say the same thing, that sometimes he spends too much time looking at things that are really cheap and all that, as I just said, it's a different kind of really cheap that we'd be looking at. What you're describing is more the kind of thing that, if it seems like it's hard to see how you would lose money in this or something like that, then that's more the kind of thing that I have to pay attention to.
How do you think you mitigate against that?
Keep reminding yourself of how much you made on the things in the past. For me, the math of it is the easy way to remind yourself of that. The truth is that the gains are so large from the things that you sell and shouldn't have, that, as one of our questions before asked about like comparing like what we'd say like on base percentage versus slugging. Slugging is so important in investing that actually you can have a very low batting average. As long as you sometimes buy winners that you hold on to for a long time. Remember that 9 out of 10 stocks, 9 out of 10 businesses, 9 out of 10 publicly traded businesses are really not good enough in the long run for you to concentrate on them instead of just being in an index. Like 9 out of 10 stocks probably should just be traded. They're just a value bet of, okay, they're a bit cheap now, they'll mean revert. It's maybe 1 out of 10 stocks that actually over a lifetime compound in such a way that they're worth thinking about, whether it's for long-term holding or just like thinking about it in a different way than just the approach of betting on pure mean reversion. But for most of the stock universe, just mean reversion. So it is just a question of price and things like that, and momentum and stuff, but we don't focus on that.
Mm-hmm. Yeah, and I guess when you are betting on mean reversion, you're having to find a bunch of new ideas probably and flip the portfolio, right?
Right, so you have to flip the portfolio more, But it's a question of what skills you have that way. What you look at the past to see what you've actually done a good job of judging and what you haven't. So I've been a fairly good judge of businesses that turned out to be higher quality over longer periods of time. So being in the right industry, the right business, things like that. So if you isolate the price part of it, whereas when buying things on the price and trying to weigh that against problems with the quality and stuff, it's harder, especially because sometimes you get returns that are about the same as the market or more importantly, about the same as what I would be getting in something else, with a lot of trouble for it. So they're more difficult to figure out when you have situations where you're either paying a really high price for something that's is really good, or you're paying a really low price for something you believe is below average. They get more complicated in terms of figuring out what you should be in.
Yeah, I have a model on my investing checklist, my personal one, that basically has just a reminder that price can't be the only form of a margin of safety.
Yeah, exactly. Yeah.
And we've talked about it before where it's like, I'd rather be a cheerleader. Be like, hell yeah, keep going. You guys are doing great.
Yes.
Rather than, oh, we didn't suck that much this quarter or something like
that, And so,
but it's still cheap, but it's still 3 times or whatever it is,
Yeah. And so that's the thing. So this depends on different people's different personalities. One thing I would say for you is I would never recommend for you being involved in special situations, because how special situations work in general is like insurance and like lending and stuff. You make small amounts of money almost all the time. And then occasionally you lose a lot on one deal. And you have to, on all the deals that you're making some money on, kind of have in your mind a reserve of, I'm going to lose money on one of these deals. And all you do is read the news. And as you approach closer and closer, you just get the amount you're expecting, really. So, and then some deal falls apart. But that's okay, because on average, you make more money. And it's true. You can make, I mean, my averages and things like that are, they're not worse at all than other forms of investing, but they're a way of investing that most people would never want to do. So that's when we talk about like Clark Street value, right? So that's a good blog to look for things like that. And it's something I've mentioned before. But I think most people are definitely not set up to do that kind of special situations investing, event-driven investing. That's definitely not appropriate for most people. Just like most people should not lend money or should not write insurance. You know, same kind of idea. Yeah,
it is interesting how you could have two totally different approaches, but you could still be in the same ballpark of performance and stuff like that. And maybe one person's working way more harder than the other. I mean, look like Clark Street Value, for example. The guy, I mean, you just read his blog. He's always turning over rocks in interesting situations and stuff like that. And he's much more diversified too, I would say, right? He posts his portfolio. He owns a bunch of different stocks. So that's a lot more maintenance and everything that goes into it.
Yes. And I think from what Buffett said at the time that he discussed arbitrage and things like that, it looks like his performance in buying and holding businesses and in merger arbitrage unlevered is pretty similar. A little more tax efficient on the buying the business forever.
So what does that tell you?
Well, he's very good at merger arbitrage too. Now, he used leverage though. So the numbers he gave are on leverage, but I know that in the actual partnership and stuff, he'd leveraged up. So his actual returns are better, but that was just because he was willing to use leverage on them, but not on normal long positions.
Do you think why we aren't constantly like nibbling at stocks, do you think there's a psychological reason behind that? And how typically when we do build positions or exit positions, it's pretty much all out or all in and then all out at the same time? Yeah.
I mean, it's the Buffett approach.
Yeah.
I know it's something that most people who like Buffett a lot don't do that. I do. And I think he would say he does that. I mean, he said that about the airlines. When people ask, like, so are you completely out of it?
I remember people were shocked.
He was like, well, once we start selling it, like, we usually, you know, we don't trim, we don't do stuff like that. And I'd say that's true. Yeah. Yeah. In fact, you know, obviously we sometimes deal in illiquid securities and things. So it's not like we just go out and put in orders the way you might for liquid stocks. But I just mean in terms of the decision of this is how many shares we want over time. Yeah. We make that as sort of a one decision thing. Yeah. So the actual trading of it, yeah, that's a little bit more complicated. But in terms of deciding to make the investment or make the sale, yeah, it's kind of an all or nothing thing that way, sure.
So I guess getting back to judging the situation by the asset performance versus the market price.
Right.
So it's like if you look at all things being equal, let's say you're looking at a bank that has a 15% return on equity and it's trading in the market at a price to book of 1.
Right. So it's cheap because it should, you know, theoretically, I mean, there are different factors and things.
Sure.
But you'd think in normal times and stuff, it should trade at like, I mean, it should trade at a much higher price. Yeah.
But you think, it
could be a little over 2. Yeah.
Talking about the actual asset returns though.
Right.
That's forward returns of the actual business, like what you're paying today versus what it could generate in the future is 15%.
Right.
That's like a shorthand way to think about it.
How much you can reinvest. The big question there is how much you can reinvest.
Correct. Yeah. So it's just a shorthand way of looking at it. So that's kind of
I always look at what the stock, I always look at what the business is doing to tell me the price that I think it's worth. So I always have in mind an idea of what the business is worth that tells me how much wealth I have.
Okay. So
and that is not what the stock price, I've never ever let the stock price tell me that my wealth has gone up or down that way. You know what I mean? I don't mark to market in my mind when looking at it, because if you assume you're going to hold it, you shouldn't market to market in your mind, you know? Now we market to market for the fund and stuff because that's what you do. But it's not a realistic way of thinking about it. You are not a lot richer if you're going to hold this thing for a long time if it goes up 50%, because it matters if earnings go up that much.
Thinking what a rational private buyer
if you're looking at the earnings for it, that's the other thing. So you're looking at the earnings. That's one way to do it, obviously, is not, I actually don't usually think in terms of what is it worth. I've said this before. I don't kind of do the DCF thing, capitalizing it. I say, what would be the returns that are generated by it? And you always want to be in the thing with the highest returns. So you can look at an apartment building and say, here's the cap rate and stuff and put a multiple on it. Or you can say, here's the cash flows coming off of it. And so if you own a business that is generating 8% of its market value right now in earnings, right? Then that could be okay. And it could be worth even more. But that's the return that you're actually getting. So if you own something that's $100,000 and it's, trading at 12, 13 times earnings, then it's like having a stream of income that's like $8,000 or so. And that's more the way I'd look at it. If you had a stream of income that was like $8,000 or something, and then someone suddenly told you, well, interest rates changed. So you have the same job, you're going to pay the same amount of money, but now that job's worth 1.5 times. Most people don't feel 1.5 times richer because interest rates went down.
Yeah, correct.
But their salary is the same. But your earnings in a stock sometimes are the same, but the stock goes up.
Alice Schroeder said that's how Buffett thinks about it. And this was a long time ago, but he basically wanted a 15% earning yield today or day one investing that he thinks could grow over time. Yeah,
and that's how I look at it. So what are the earnings? Now some situations are more complicated than that, but what are the earnings and how much can they grow by and all of that? So what's the return you could get in it? Not trying to think about the return in terms of what others will pay for it. Now, this is a little conservative because in my experience, I can look and match what was my actual returns in stocks versus the numbers I just told you. And the returns in stocks is higher. So something's happening there. Either people are bidding up the stock, or like it's happening faster than you'd expect.
The multiple re-rating.
Yeah, the multiple re-rating, and maybe the multiple re-rating is happening faster than you expect. So either they're bidding it up beyond other businesses, and or it's happening much quicker than I expect.
Correct. So let's say Geoff underwrites something that he thinks could return 15% over 10 years. Sometimes you could get a better return because you get a multiple re-rating in year 3 or year 4 or something like that. Right. I mean, just look at Buffett with Apple.
Yeah,
there was a multiple re-rating in year 1, basically, right?
Exactly.
Where he had 100% return pretty much instantly because everybody bid the stock up.
Right. And Coca-Cola started going up and went up for 10 years straight or whatever. Washington Post did badly for like 3 years and then did great for 10. So at the end of 10 years or whatever, it would look like he had an amazing investment, but I think it was very mediocre for 3 years. Whereas Apple, it looked great within 3 years. Yeah.
Well, I mean, Berkshire Hathaway was like that as well.
Yes.
The stock went over for 3 years. So imagine being an LP, a partner in his fund.
Right.
You follow him into Berkshire. Buffett wrote a letter basically saying, well, I'm wealthier, I'm less motivated, different part of my life. Also, I don't understand this new type of investing that's going on in the market.
Right.
You invest with them in Berkshire and then the stock goes nowhere for 3 years. We talk about 3 years like it's 3 minutes, but 3 years is a very long time.
Yeah, we talk about
as long as we've been doing this podcast.
Right. We talk about when looking in the past. But for me, if I expect to hold it, then that is how I feel. Honestly, it is. That's what I care about. And I get more uneasy when a stock's going up and I'm not getting the quarterly reports and things that I want to see with the business doing well. I'm always happy to have a business doing well and the stock not doing so great. That always feels good. That's just telling you your future returns are going to be good.
Yeah, you're just the opposite.
But it's true. That's what it's telling you.
Totally, 100%.
And you should feel more comfortable holding it. Now, yes, you could be annoyed, and many people are annoyed that it hasn't gone up yet. But the odds of it going up in the future get better and better as they report good earnings, as everything about the business is going well, and yet the stock is not responding as strongly. And I mean, the stock can go up. If the stock goes up 10% and earnings go up 20%, that's good. If the stock goes down 5% and earnings go up 5%, that also could be good. But you like to see earnings. You like to see the actual business confirming what you felt when you bought into it, right? And sometimes I have been in stocks that went up, and I thought the earnings weren't that great or something, or like the business I had. I feel if the business didn't perform as I expected, then I feel like I've made a mistake, even though I made money in the stock, and that has happened. And I've gotten questions from a few people about that. They said, I made a lot of money in the stock, but I kind of feel like I was lucky, because it really didn't do as well as I was hoping as a business. And I don't really understand why it went up a bunch.
Or I sold it and then it went down.
Right. But so, yeah, exactly. Because eventually that happens. But like I timed the buying and selling really well. So maybe their skill is in timing the buying and selling really well, which is something that I am not good at. I'm not the person to ask how much do you think the stock will open up at if there's been news of like what, quarterly news about whatever.
Yeah. Every time I do that, I'm always wrong on that.
I'm guessing what'll happen.
I mean, just like, oh my gosh, this was just a great report. The stock's going to open up 20% tomorrow.
Right.
Nothing.
And so there's some that baffle me that way and others that don't. We pointed out that there was a thing with Points International and airlines and stuff, and I would have expected a big decline from it, and it initially went up. Eventually it declined, but initially they gave pretty good, they sounded more positive than the airlines had sounded. And so I figured, oh, well, if when that happens, the stock goes down usually, usually if you sound really positive, people are like, well, that's not possible. Then, it goes down. But that's not what happened at all. So,
Yeah. You'd be surprised too how many CEOs use the current stock price as well. They're pricing in a lot of future growth. And I know every single CEO on the planet, they kind of follow the Buffett model, right? Where they said, no, we don't care where the stock or price is. But I just don't actually think that's true. And I think Buffett actually, to him, if it goes down or if the stock stays the same, but they continue to grow, he's like, great, I could buy back stock. But again, getting back to the, 9 out of 10 rule, I would say CEOs are the same way. It's kind of like Jeff Bezos. He always talks about how a lot of times people will congratulate him on a quarter or something like that. And he's like, oh yeah, thanks. I'm already 2 years ahead because it's all about the future growth. Like we did that work a long time ago, but thank you.
Yeah. And I'd say the same thing for stocks. If we have a good quarter or something, usually it means that it's because of a purchase a while back.
Yeah.
And I know that from other investing things that in the past with my own money or something. One of the best years that I had was like I hadn't changed anything in 2 years. So it took a while for it to get recognized or whatever. But like the earnings situation got better, and then the guidance for the future got better, and then that kind of thing.
But special situations is more congratulations on the last quarter. Maybe you made a great move. It could be like that.
It can be, yeah. It also can be luck. And people can recognize that. So if you can show that they're isolated incidents, that they're independent events of each other, it can just be bad luck. It's like I was talking about with universal insurance. One thing that was kind of worrying me about that is they have guidance and all that, and I was trying to analyze it. You can just have 2 of the worst hurricane seasons in a row. I mean, there's nothing the company can do about it, and there's nothing you can do about it. But people get annoyed if you miss for 8 quarters in a row or whatever. But that'll just happen because of weather, and there'll be other times when it doesn't happen. Mm-hmm. So it's hard to guide in a business like that, and yet people do kind of focus on that, even in businesses like that. Even in business with weather, it's like they've been missing on this lately. I don't know how you miss on weather, but
yeah, got it. How can people improve when it comes to psychology in the markets?
I don't know. I'm really skeptical that they can improve. Very skeptical. I think there's certain things that they can do, and if you figure out that it's an issue for you, then I think you can kind of target it to that in your behavior by adopting certain habits. Sometimes just reminding yourself. I mean, honestly, with the look through earnings thing. So I do always think how much earnings is supporting the stock that we have right now, basically. So when I look at the stocks, I think, do we have, I don't even think in terms of the PE really. I think about the flip side of the earnings yield. And if that number says 4%, then I'm thinking, well, this isn't good. This is pretty expensive. And I shouldn't get too excited about what's happening with the price. But if it says 8%, then we're good. Yeah. We're earning 8% on our money. That would be if you own an 8% bond, you'd be pretty happy. Mm-hmm. And if you think the odds are that earnings will go up over time rather than down, then what you own is better than an 8% bond.
Yeah. And how you finish that equation, if your hurdle is 15% over time, you're earning, let's say 8 to 10% today, solve for X, right? How much do you need in growth to kind of get to that 15% number?
Yeah. The hard thing about investing is that the gains and losses happen in such short periods of time. Mm-hmm. So a lot of times what we expect with the business kind of does turn out. But then you look and you go, oh, but went up 100% in 1 year, then flat for a couple of years.
You think about like a moving average in a way, right?
So the business is like it grew 20, 30% a year every year, and you for a while, and you think, well, that's amazing. I'm sure that's what you expected when you bought it. I'm sure you bought it. You were very happy with it, whatever. And instead, it goes up more than 100% in a couple quarters. It does nothing, or it's down in other things, and you kind of read into that a lot of stuff. That's an important thing. I think people assume the market is more efficient, especially in that the market is telling them more than it is. Day to day, the market is mostly moving for liquidity reasons.
Market makers, et cetera. Yeah.
Yeah, I mean, it's just moving because because people want cash and don't want stocks and things, or because they vice versa. It's not really because people's opinions about the value of a business has actually changed by that percentage. Mm-hmm. That's pretty rare. There are days like that. I mean, that is true. In the middle of the financial crisis or something about a bank, that might be it. In the middle of a OPEC thing about oil, yes, there can be big information things on a single day, or fraud or something. But for most things, it isn't. And so when your stock drops a lot, it's really just because of that. People want to get in and out and that kind of stuff. and we see that all the time now, right? With people talk about rotation from this thing to that thing. It doesn't mean that suddenly they think, oh, banks are going to make a lot of money. And then the next day they think, oh, tech stocks are going to make a lot of money. It's because of money flowing into those categories of things about, what they want to be in.
Mm-hmm.
Yeah.
Well said. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focused Compounding Podcast. If you're watching on YouTube right now, go to QuickFS. Even if you're listening, go to quickfs.net, sign up, tell them that you came from Focused Compounding. In the checkouts, you'll see a spot to do that. Geoff and I use it every single day to look at the financials, long-term financials, 20 years of stocks. It's, as they say on their homepage, financial modeling made quick. Whenever we're looking at a company, we just go there and plug it in. It's a great website. So go check that out. Hit the subscribe button both on YouTube and the podcast side of things. Follow me on Twitter at Focused Compound. DM me or email me. info@focusedcompound.com. Any questions that you have, and we will pull them and answer them on the podcast. If I don't answer yours directly, what I typically try to do is just group them together because we get a lot of questions. So if it's not yours word from word, I try to hit on all the topics. I want to thank everybody so much for tuning in with both of us. We'll see you in the next podcast.